Hey, good morning, everyone. Good morning.
Good morning, Professor.
Hey, good morning, Samira. Hey, Sorav, are you there, Sorav? I see two people in the collaborate, right? And briefly before I came to collaborate, I checked. I checked into I have three people. Um, I have three people in the discussion board. So I'm still waiting for Lewis to join the collaborate. Uh, and Zachariah, I'm sorry, Zachariah is here. And good morning, Zachariah.
Good morning, Professor. How are you?
Good, good. So I'm still waiting for Lewis is coming in. Okay, good. So I guess I have. Good
Good
morning,
morning, good
Lewis.
morning.
Okay, so I guess I have the cream of the crop from this class. Okay, all righty. So we're moving on to topic six, stock valuation today. And of course, you know, you can go to course material and uh, download the necessary files. Of course, I have two versions, PowerPoint and PDF version, but they are slightly different. I'm going to use this PowerPoint, okay? And then, of course, there's Excel file. We're going to use this later. So first, if you download that PowerPoint, uh, first of all, we need to start with some institutional aspect of the stocks. Um So actually, when we say stocks, we normally refer to common stock, but also there is preferred stock. Okay. However, preferred stock is not the ownership. Common stock is the ownership, right? And common stock is the normally called equity. Common stock is normally what's normally called equity. Equity means we already know uh, it's the capital that came from the owners, right? Uh, and from topic two, right? Balance sheet and income statement. You already know uh, equity is uh, part of the total assets, and total assets it comes from equity and debt, and debt is mostly um, bond. I mean, there can be some loans from the bank, but most of the debt capital is raised through sale of bonds, especially if you are a um, publicly traded, publicly held company. Whereas, uh, stock equity comes from sale of stocks. Okay, so the common stock can be privately owned, meaning by the ownership is only limited to some private individuals or institutions. That means it's not traded in the stock exchange. Okay, um, if ever it is bought and sold, it's only between these closed group, right? Closed group. Uh, so most of the companies before going public, they are privately held, right? And then when the company goes public, right, then it's publicly owned. Publicly owned means also called publicly traded. That means the stocks of these companies are publicly traded. So only when the company goes public, then their stocks are traded in the stock exchange. And when they go, so obviously before going public, companies are generally small, right? And because uh, the benefit of going public is that you can tap into a larger pool of funds, right? The funds coming from a large public, uh, obviously, you can raise more capital, more equity capital by going public, right? If you're private, it's only limited to that, private group of investors. Of course, sometimes even the publicly traded companies can go private, right? And you've seen that. Uh, does anyone does anyone know any instance of a publicly traded company going private? Hmm? Does anyone remember? I mean, that happened quite recently. Anyone? Are you guys there?
Yes,
Yeah.
Professor. So the
Yeah,
company
but
was
if you,
public and then they went private.
yeah, I mean,
Uh-huh.
it happened very recently. There was an example of a company. Yeah, who said that? Anna, of course, Anna. Twitter.
Oh yeah.
Twitter.
Yes.
Elon Musk bought out Twitter. You know what does that
I,
what that
I
means?
did hear that in the news. Yeah.
Yeah, Twitter was a publicly traded company, and then Elon Musk bought it out completely. I don't know how much he I think it was $8.8 trillion. Mhm. He paid $8.8 trillion. So that means he bought theoretically every Twitter shareholder gave up their stocks, right? Of course, they got paid. So public companies can go private as well. And about 2 3 years ago, Elon Musk also uh, Musk also talked about taking Tesla private at the time. Um, and how? This time in Twitter, right? He sold he sold some of his Tesla holdings. I don't know what percentage of his holdings, but it wasn't that. I mean, probably 20% of what he had of Tesla, he sold. Maybe it was less than 20%. Still, he owns a lot of Tesla. But 20% of his Tesla holdings is sold and used it to buy out Twitter. And then uh, back in then, about 3 years ago, when the talk was about taking Tesla private, then where would the fund come from? That was also a big talk of the town. Where would the funds come from? Hmm? Where would the funds come from? 3 years
From
ago, huh? Any? Yeah, Samira.
from selling the Tesla stock.
No, no, no. Look,
Oh, what? Oh,
he
from
was
from making
Tesla.
Tesla
Tesla was,
public.
huh?
From making Tesla public.
No, Tesla was
Mm,
already public. He wanted to take it. He wanted to take it private.
yes.
He'd have to get a loan or something. I don't know.
Yeah, yeah, yes, of course. The question was then where would this money come from? At the time, there was a talk that he was trying to get the money from Saudi Prince of the Saudi Arabia, right? So then the money was probably coming. Oh well, but it didn't happen. Uh, what was behind story was that there were there was such a huge speculative institutional investors like hedge funds trying to uh, trying to short sell Tesla. Okay, what is a short sell? Short sell is selling before you buy the stock. Then you might wonder, how can you sell before you own the stock? It's possible because uh, you can borrow the stocks from the brokers and sell first and then buy back later. Because if you sell, you borrowed something and you sold that, so you have an obligation to pay back or return. You borrow the stocks from the brokers and you sold, then you owe the broker those stocks, right? So then what do? You'll have to buy it back and return those stocks to the brokers. And why would you do that?
Oh, because you want the price to go down so that you can buy
Exactly.
it back at a cheaper
Exactly.
price.
Exactly. You because how do you make money in anything? You buy low, sell high. You buy low, sell high. Huh? So Lewis, I'm gonna give you 1 point for that. Uh, that's the way you make money. Um, but then if if the market is in an uptrend, if the market is an uptrend, always think about it. If the market is always going up, you can always buy at some point, and at a later point, the price is higher, so you can sell and realize profit, right? Um, that's the usual case. You want it's called long strategy, or buy and hold. You buy and hold, and the price goes up, and then that, you sell. So it's buy low and sell high. But what if the market is going down? If the market is going down, then you sell now, buy back later. So you sell high, you sold high, buy back low, you realize profit. It's just happening in uh, reverse chronological order, right? Usually buy must happen first, then sell happens later. But you can reverse this. Sell. Then if you sell first, you are you do that because you're betting the market is going to go down. Nobody knows that yet, but you think you know that. You're betting that the market's going to go down. That's called, and a lot of hedge funds do that. Um, and they are so actually, back in 2020, I believe, 2021, GameStop, right? GameStop. You remember GameStop? That was back in last year, early March. Does anybody remember what happened with
I
GameStop?
definitely remember short.
Hmm?
I remember GameStop. It was like short. It was like a short squeeze or something along those lines.
Yeah, yeah. What
And
does
then the
that short
price went.
squeeze mean?
The price
Yeah,
went crazy high for no
yeah,
reason.
yeah. It's all, those, institutional investors, they are really, really, really foul, uh, villainous, evil guys, hedge funds, they try to, yeah, pump and dump. They pump up the price and uh, dump it. And then the price goes down, um, they buy back, right? That was short squeeze means there's a lot of pressure for the price to fall because these hedge funds are uh, playing these dirty games, and
But they have
a
to
lot.
be, but
Mhm.
Professor, these shorter, they have to be in the market to adjust the price sometimes.
Right, right, of course they have, you have to be in the market, of course,
I
uh,
mean,
now
to short.
Anna just Anna just put something in the chat box. Pump and dump. They pump up the price, and then they sell, and then the price will plummet, and then they buy back, right? And there was a lot of attempt on GameStop uh, to do this by hedge funds, and then just average shareholders of GameStop, usually millennials, generally those who uh, have even under this falling prices, they held on. Actually, they bought more and more of GameStop, so they pushed up the price from falling. If the price doesn't fall, those short those hedge funds that were aiming for dumping the stocks for to make profit from short, they actually cannot make profit because uh, against their their own expectation, the price went up, and then they had to buy back at a higher price. So a lot of hedge funds uh, made a lot of loss. They lost a lot. So this was a civil justice in a way. I mean, in the stock market, usually it's the large institutional investors and hedge funds that can mobilize a huge amount of capital that dominate the market. I mean, they take advantage of the market for their own sake, and leaving the rest of the market participants bleeding. And that's the nature of corporate raiders, hedge funds. They are the scum of the capitalism. Actually, that's what makes the capitalism a hell, because of those handful of bad guys, right? Um, so actually, those hedge funds and those bad guys should be wiped out of the financial market. I mean, without those guys, the financial market will be a relatively nice place to invest and grow your money. But because of those evil villains, um, like I don't know if you guys have seen the movie Wall Street 1 and 2. Wall Street 1 was released back in '83 or something like that. Wall Street 2 was released in late 1990s or early 2000. There's a guy named Gordon Gekko there. He's like the hedge fund manager, and he's also a corporate raider. They are killing off. Corporate raiders are basically killing off good companies. To make profit for themselves. And what happened to Kmart, J.C. Penney? I don't know if if you heard about J.C. Penney. Why did they go bankrupt? Of course, J.C. Penney wasn't doing well, but the CEO of J.C. Penney actually deliberately bankrupted it. Why? Because the CEO was a hedge fund guy. And think about it: hedge funds, if they are are holding like majority shares in the in a company, then they can do it. They can appoint themselves. Because if you have 51%, nobody can vote. Nobody can win against you in voting, right? 51%, is the supermajority. So this hedge fund guy actually appointed himself to the CEO of J.C. Penney, and then he bankrupted it deliberately because that way, then the hedge fund made a lot of profit that way. So that's a corporate raider, and hedge funds and corporate raiders, they are all basically same sort. And these are the the people or the entities that even ruin a national economy, they don't care about what happens to the economy. Whatever maximizes their profit, they will even ruin the national economy, right? That's so anyway, where was I? So yeah, so GameStop, actually, the price went up because a lot of just average market participants kept on buying and buying. Uh, they defeated, they beat up the hedge funds, and uh, so that was a sort of like a poetic justice. It was a poetic justice against the villains. Um, that's called, short. And the whole thing came to this because Elon Musk wanted to take Tesla uh, private by borrowing money from the Saudi prince, and then but why? To thwart that short attempt, to thwart that short attempt, because there was a lot of short attempt on Tesla um, about 2 years ago. Well, that kind of digressed a lot. Yeah, I don't. Yeah, of course. Wherever So okay, back to where's my pen? Oh, and so common stocks and stocks, basically preferred stocks too, pay dividends, but not always. Preferred stocks generally pay dividends all the time without skipping, but sometimes even the preferred stocks pay can skip dividends. But common stocks pay dividends only after preferred stock. Okay, that's the only thing. I mean, preferred stock is not better thing than common stock. Preferred stock is only preferred in the sense that the dividends are paid before the common stock. Okay, dividend is not. Why? Because dividend comes from where? Where does the dividend come from? You know this because you learned this in topic 2. Where does the dividend come from? Anybody?
The company's profits.
Yes. And who said that?
Lewis.
Lewis. Okay, Lewis, you got another 0.5 for that. Yes, of course, it comes from the profit. But think about it. Then, if there's no profit or profit is negative, there's no way they can pay dividends. Okay, so theoretically, you remember in topic 2, in income statement, you learned, at the end of the income statement, right? There is EAT, earnings after taxes, which is net profit, right? Right. And some percentage of this will be dividend. Let's say if it is 10% of EAT, I told you this is called dividend payout ratio. Dividend payout ratio. And then, so it has to come from the EAT. So if the EAT is 0 or negative, there's no way they can pay. And then whatever is left after that is called retained earnings. Remember that? Retained earnings. So think about it. Because dividend is some percentage of the EAT, theoretically, it's supposed to go up or down with the level of profit. If the profit is higher, then 10% of that profit is obviously higher than before, right? But in reality, it's just that's just theory. In reality, the dividend is generally just a token amount, just symbolic. Why? If you look at Apple, I mean, we've downloaded Apple's data. So when we downloaded Apple's data, then you've noticed that Apple paid dividends, and dividends are quarterly, and every quarterly point, Apple paid dividends, but their dividend was only like 22 cents or 23 cents. Something like 22 cents, 23 cents at best a quarter. Then what does that mean? Annually, it's just about $1. It's just dividend is just about $1. But Apple's profit wasn't, does that mean Apple's profit was even every quarter? No. Obviously, it must have, there must have been a fluctuation in Apple's profit, quarterly profits. So actually, the actual dividends are not directly related to the quarterly profit, but it's actually determined. So then, how do they? What does it depend on? Actually, it's based on the projection. It's based on the projection of the annual profit. I mean, if last year the profit was, let's say, $10 billion, and then, this year, based on, Apple's growth rate, earnings growth rate, they make a projection. If the earnings growth rate was 10% annually over the last 5 years, then, next year, 11 billion. And based on that, they already, based on, annual growth in the profit, then they predetermine, based on that forecast, they predetermine, the dividend payout ratio, and based on that, But again, think about it. Even if that's the case, if you look at last 5 years, Apple's dividends were still about every year, every quarter, it was just about like this. So that means in reality, it really doesn't really depend on the actual earnings. Okay, then so dividend is not really a big deal, right? Why? Because it's just a token of, Apple shareholders. Apple shareholders don't care much about the dividend. They don't care much. I mean, unless you have 1,000,000 shares of Apple. If you have 1,000,000 shares of Apple, right? Million shares of Apple. I mean, annually $1, right? That means annually, if Apple pays $1 dividend, it's $1 million. Isn't that right? So unless you're like a majority shareholder, a big shareholder of Apple, you don't really. I mean, if you have only 100 shares of Apple, this doesn't mean much, right? Annually, of course, if they pay $1, it would be $100. But $100 a week may be something attractive, but $100 a year, it's a joke, right? But anyway, so once again, it's a signal effect, right? Signal. A lot of dividend is generally a signal, okay? It's a signal that the company is profitable. And the dividends can be, normally dividends are in cash. Of course, dividends are in cash most of the times. Sometimes you can have, you receive dividends in stocks or in merchandise. This is horrible. Merchandise, think about it. If Samsung pays dividends in a refrigerator, if you have, 100 shares of Samsung and, they pay, uh, that's ridiculous, right? Um, for every 100 shares but sometimes this happens. And usually, the problem is, how would you pick up that refrigerator, right? That's, and when you pick up the refrigerator, uh, what do you do? I mean, you have already two refrigerators, three refrigerators in your home. There's
You're gonna have to
no
sell
room
it
for
at
one
that
more.
point.
Huh?
You're gonna have to sell them at that point.
Yeah, but where would you sell it? I mean, through um, I mean, some marketplace like on like Facebook Marketplace, and that's gonna be a headache, right? Hassle. I mean, how do you ship it? I mean, will uh, obviously this is rare, but sometimes some companies do this to wait to release as a means of releasing their or unloading their unsold inventory, right? To get rid of their. Uh, but if they pay a dividend in stock, that's not good either. Why? Um, think about it. Stock is a equity paid in capital. So think about it. There are two types of equity. You remember, right? Uh, Equity basically by selling stocks, by sale of stocks, and the cash comes in. That's called paid in capital. Paid in capital. Second source of equity is EAT. You remember that EAT at time one, right? Uh, will be added to equity at time zero, and then that's equity at time one. Remember that? EAT is internally generated um, equity, equity generated by uh, operating activity, right? So basically paid in capital is the original source of paid in capital is the original source of equity at time zero. And at the beginning, if the equity is $10 billion, that means $10 billion was paid in by the investors, right? By the stockholders. And then the equity, um, so how many shares were sold? Let's say 10 million shares were sold. So 10 million shares outstanding. 10 million shares outstanding, right? Then what was the price per share? What's the price per share? 10 billion divided by 10 million. That will be $100, isn't it right? 10 billion. Uh, oh no. 100 million shares. Let's say 100 million shares were sold. Uh, if 100 million shares were sold, that means the book value per share at time zero, right? This divided by this, so then book value per share at time zero is $100. Now think about it. The book value of $100 is supported because there are 100 million shares outstanding for this $10 billion, right? And if the only way this price would go up is if there are more shares sold. Let's say, so if 10 million more shares were sold, if 10 million more shares were sold, let's say, at the price of $100, then there will be additional paid on capital of 1 billion, isn't that right? Then if this is the case, additional 10 million were still sold for $100 a share, then this will become total equity will become 11 billion. Isn't that right? Another 10 million sold at $100, right? That's 1 billion. So then think about it. The price of the stock will remain still $100, right? Of course, if the demand goes up, this will be even selling at a higher price. But then there will be 110 million shares outstanding. 110 million shares outstanding, right? 110 million shares outstanding at 11 billion for $11 billion. So the price will, but only because this 10 million shares were sold and paid in capital, it added. But think about it. The company paid dividend to the existing shareholders. The company paid, dividend in new shares. Now they distributed, so they paid 10 million shares as dividend to the stockholders. Does that bring in any new capital? Does it bring in any new paid-in capital? Is anyone
No.
following? No, it's not bringing in any new capital. It's not paid-in capital. There's no paid-in capital. So that means, equity is still 10 billion. Equity is still 10 billion, but there are only 110 million shares. It's just like, so this is obviously, this is a ruse, right? This is a ruse. It's a trick. What happens then? What happens to the price of the stock? The price of the stock will go down because you are dividing 10 billion by 110 million. The price will be diluted. And no shareholder in their right mind will like this, right? So obviously this is not a good thing. A company that, paying dividends in additional shares, that's a bad idea, right? Preferred stock next. So preferred stock is often considered quasi-debt, almost debt, because much like interest on debt, I think in Latin, it's Latin. In Latin, it's probably pronounced quasi, or so quasi-debt, that's fine. Much like interest on the debt, it specifies a fixed periodic payment. So just like the coupon on the bond or interest on the loan, the preferred stocks payment is a fixed amount. In other words, it's not a percentage of the profit. If it is some percentage of profit, it will go up and down, but no, it's just like interest. So that's why it is, considered half debt. And the preferred stock is unlike debt. However, it's not debt because it's a perpetuity. It has no maturity. Now, debt has maturity, right? Bond is a annuity because it has maturity, right? Maturity or uppercase T. However, preferred stock is a perpetuity. Perpetuity means it goes perpetual, right? It's a perpetual annuity. That means, infinity, right? So and because they have a fixed dividend, right? So fixed claim on firm's income, that comes before, that takes precedence over the claim of common stock. Yeah, so no common stock can pay dividends before paying dividend on the preferred stock. Um, that's why preferred stockholders are exposed to less risk. However, preferred stocks don't come with the voting right. That's why preferred stock is not the true equity, because there's no voting right. Sometimes, uh, uh, allowed to elect one member of the board of directors, but it doesn't come with the award. And sometimes, think about it. Although preferred stock pays, fixed dividend, it's not guaranteed. Think about it. You have to have profit first, right? So in other words, if EAT is negative or zero, there is no way you can pay dividends, right? Even preferred stock. Um, but once they pass up or skip, once they skip the dividends, then uh, what do they do? I mean, do they forget about it, or uh, there are two types. One that can forget about it, another that cannot. So there is a cumulative preferred stock. That means, they will have to pay all passed up dividends, and passed up dividends are held in arrears. Arrears, if something is in arrears, that means you are behind payment, right? Then there are payments that you missed, held in arrears. Actually, arrears comes from the French word arrière, which means, behind. So if you're in arrears, en arrière, that's in French, being behind. Uh, so there's, unpaid dividends that are piled up or accumulated, and then they have to pay all these uh, accumulated dividends before they have to pay all and the current dividend before paying dividends to common stocks. If it is non-cumulative, then forget about it. It's gone. Okay. And then they have, callable feature like the callable bond, conversion feature. These are just the institutional aspect. So you can just read up. And so we're out of time. So I think we're out of time, aren't we? We still have like 5 minutes. So going public, that means, IPO, initial public offering, right? Now, usually the IPO is, what makes uh, what allows the original shareholders, right? The founding members and original shareholders, big fortune. What allows them to amass big fortune? Because at IPO, usually, prices, of course, a company that won't be in demand, they won't even go public. And the company that has a very good prospect of, thriving, will go public. And it's basically in role of the investment bank. Investment bank is like the broker for IPO, right? And investment banks they charge fee, right? And they make money out of this. So investment banks are really very selective They are very, selective in selecting the company to that they will, uh, underwrite, right? Um, so most companies that, but of course, not always a success story. I think Airbnb. I think Airbnb wasn't a very wasn't Airbnb or uh, WeWork. I think WeWork wasn't a very quite a success, um, and WeWork was heavily invested before going public. It was heavily invested by SoftBank of Japan, which is a huge fund asset management company, and SoftBank was very successful in everything they uh, uh, you know invested, but only WeWork was the only stigma to SoftBank. Actually, the chairman of the SoftBank is a Korean Japanese, second generation Korean Japanese, I believe, who is a legendary guy in the. His name is Masayoshi Son. Legendary guy, but to his uh, to his fame, I think is a decorated. I mean, as an investor. I think WeWork was the only stigma to his career. But that's since that's all the time we have, we're gonna have to talk about this next Tuesday. Okay, so I will have to stop recording. And so, any questions so far? Any questions? Any questions? Hmm? All right. If you don't have any more questions, uh, okay. Have a great afternoon, everyone. I will see you guys next Tuesday. All right.
Thank you, Professor. Have a good one.
All right. You're welcome. Take care, everyone.
Thank you.
All right. Take care, Sorav. All right. Stop recording and sign out.